Welcome, everyone. Today, my guest is Lead Analyst Logan Mohtashami to talk about the possibility of 8% mortgage rates and what he's watching to see if we'll get there in the short term. First, here's a word from our sponsor. Hi, I'm Sarah Wheeler, Editor-in-Chief at HW Media, talking to Desmond Smith, Chief Growth Officer at UWM, about SafeCheck. Desmond, how does SafeCheck work?
Hey, Sarah, how are you? So I would say first, SafeCheck is allowing LOs to give their borrowers peace of mind. So I'd start there. Trigger leads have become a very large issue, not just in the mortgage space, but in any time someone's getting any type of credit. So we created SafeCheck to help prevent kind of that aggravation and nuance of receiving, tens, 20s, hundreds of calls that consumers receive. So what happens with SafeCheck is any LO who uses UWM, it's an exclusive product, SafeCheck is to UWM, they would be able to either pull a single or a tri-merge soft pull credit report. And while that credit report is being used to run AUS, they will have time to opt their consumer out of any solicitations, and then therefore they will not receive all of those annoying calls and annoying solicitations. And that is also a big benefit because the cost of the credit bureau is much cheaper by leveraging SafeCheck. So it really is a win for LOs, and it's obviously a win for consumers so they don't receive so many phone calls offering all different types of products and services.
I can see how that could be a game changer. Thanks, Desmond. And listeners, you can find out more at uwm.com. Logan, welcome back to the podcast.
It is wonderful to be here. Second interview of the day.
I know. So you were on CNBC Squawk Box this morning for a pretty long segment on housing. So get us up to speed on that. I know, I watched that and they really wanted to know about mortgage rates, right? I mean, that's what's in the headline. We're at the highest point in 20 years or more than 20 years. So what was your main point to them?
Well, CNBC talked about, the NAR was expressing concern about 8% mortgage rates. And of course, for me, I'm a bond market guy first. I don't target mortgage rates. I target 10-year yield channels. So for those that have access to HousingWire Plus, you can read exactly what my mindset is, because I think targeting mortgage rates, not a lot of people want to do that. There hasn't been very good history on this for a lot of economists or analysts, but I target 10-year yields, and I go back and show everyone my work in the previous expansion, what happened during COVID and now, and we're kind of right at the high end level of the 10-year yield. So 4.25%, we're almost 7.25% to 7.5% mortgage rates. And I try to give a reason why that, the Federal Reserve is actually probably more happy now where they are with inflation and rates, and why it's going to be a little bit more difficult to really take off from here. But with CNBC, the question was, well, what does it mean for housing? Well, of course, higher mortgage rates, demand gets weaker. That's all kind of obvious. But one of the things I try to express to them is home sales kind of already crashed. And I think their confusion is the same confusion as everyone is having this year. It's if housing costs are much more this year, why aren't home sales crashing like they were last year? Well, I've always had this fundamental belief. It's something that I've written about a lot. We talked about it on November 9th last year on our articles. We get to around 4 million on existing home sales. The marginal home buyers are already kind of wiped out, and the affordability issues aren't as prevalent down here with these home buyers as they are up when we were, 5.5 to 6.5 million home sales. So home sales are slowly moving lower, where there's a good shot that we'll be under 4 million at some point this year as rates have stayed higher for longer. But it's just not the velocity crash in sales. And I think the confusion by everyone is, how are home prices at all-time highs? 5 of the indexes are at all-time highs. And the whole concept of the savagely unhealthy housing market was this notion that, well, homeowners are doing really good. They are in control. And when they are in control, it's not just a hedge against inflation, right? That's one of the talking points we've done for some time. But you are hedging yourself against the Federal Reserve. Jerome Powell, Kashkari, Logan, Waller, all these people, they said, we're trying to make your lives better by bringing inflation down. You're raising the cost of living on everyone, right? Credit cards growing up, car loans, everybody. That is inflationary. You're bringing it into the system. And American homeowners like, no, Jay, we're not moving, right? And some of the frustration of the Federal Reserve is that their rate hikes or higher mortgage rates haven't destroyed the economy enough. And we had 5.8% GDP retail sales beat, and a lot of this is that the American homeowner is like this golden eagle right now around the world that, housing markets around the world have to deal with, recast rates. There's still inflationary issues out there, but the American homeowner has this beautiful backdrop of having a low total fixed costs. And when you have a very low total fixed cost, you insulate yourself from inflation and a very aggressive Federal Reserve. And that's kind of what I try to relay to CNBC and their viewers, that new listings data has been trending at all-time lows since mortgage rates got above 6%. There's nothing in the data that's showing any stress in the new listings, but we haven't had another leg lower, thankfully, and hopefully this last move in higher rates doesn't change that, because we have to have a functioning housing market. Why? Because, Sarah, like we always said, people rent, they date, they mate, they get married. 3.5 years after marriage, they have kids. They typically buy homes. Okay. We have to be a country for young people, not older baby boomers who are like, oh my God, these kids aren't bidding against me anymore. I can buy a house. And we'll see what the market does with rates going out for the rest of the year. But there was a lot to unpack. And I think getting a very late call from CNBC, hey, listen, the NAR is talking about 8% rates. You want to come? Yes. Let me do my job. Let me explain the madness of the United States housing market.
So this goes with, you wrote an article for us for HousingWire that was, this is the first real test of rates. Will they hit 8%? And I think the idea that rates could hit 8% is pretty terrible for anybody in the housing industry, right? Because, I can understand why NAR kind of, raised a red flag of like, this is not good. This is not good. But in the article, you went through what is it that would have to happen to get there. And you even just, you just said you really track the 10-year yield, and you're looking at that for your cues about what that's going to do to mortgage rates. So tell us, Logan, 8%, is that what's coming?
If the economic data stays better here, you can get there. But my thing is that, do we stay here long? Do we even go higher? The real yields where the 10-year yield is and inflation is, the Federal Reserve finds this to be very restrictive now. We're starting to hear talk about, well, if the growth rate of inflation falls, we're going to have to start cutting rates. And also, the Fed doesn't want to push it too much at this point. So they're monitoring everything, because we're at a different spot where inflation is. That's always the key. And again, as of right now, the 10-year yield is at 4.23%. It's now back into the channel. Yesterday, in the article that I wrote, I try to highlight, well, my whole thing is I wanted to see if the 10-year yield would hit 4.34%. This gets into the really nitty-gritty technical stuff of bond markets, and we didn't get there. We reversed course and bond yields fell, but so far the channel's still there 99% of the time. I'm not a 8% mortgage rate person for 2023. I had my 10-year yield channel and I work off of it. But one of the things I showed in that article, in the previous expansion, there have been times where I go above and below that range. We don't stay there long either way. We just go back to where we were. So again, track economic data. It's, we do the HousingWire tracker to give a heads up on what could come out and move. And retail sales was good. Industrial production was good. GDP benefited from that. And we would be having a much different conversation today if retail sales had a big miss, if jobless claims had a big spike, if industrial production had a miss. So right now, just kind of work with the economic data. We're at the high end of the range. And eventually the Fed has to make comments about the housing market, because this is the one area in the economy where home sales are near 21st century lows, right? So, and the whole dual mandate is not about home prices, right? I think that was the mistake Jay Powell made by saying housing reset. This was the mistake Jay Powell made by saying housing was in a bubble, because every bubble boy, if you're saying something's a bubble, that means there's going to be a huge crash and there's going to be massive supply. So Jay Powell was actually joining forces with the clan that doesn't like him very much, the housing bubble boys. So it was a weird thing to see, but at some point they're going to have to like talk about housing in a more coherent way that makes sense with the real-time economic data. And that was one of the things I just try to stress on CNBC. Homeowners are doing good. You do not have to feel bad for homeowners. If they want to move, if rates fall down, what we've always said, when rates go down, demand picks up. When rates go up, demand falls. That's always been in the data post 2010. But they're waiting, right? And they're waiting. And the problem is home prices are at all-time highs, and housing costs are going up. It's savagely unhealthy, and there isn't a quick fix, right? We're almost in September now. So the year is mostly done. So we have to start thinking about 2024. But I think Melissa Lee was saying, well, what if things just crash or something? And I said, people are staying in their homes, are doing good. This is not like stocks. Stocks have the velocity of going up and down like crazy, but home prices don't have that unless you have massive supply, massive distressed sales, and not there. We don't have that kind of marketplace.
Let's talk about the Fed a little bit, because to me, we're getting into the territory where the Fed is going to start to feel stressed because, there's something about 8%, for instance. The fact that we wrote an article, that you wrote an article that said, are we at 8%? The fact that CNBC had you on and you talked about 8%, that is like a new level. And I feel like it's the kind of level that at which people will start to, your general consumer understands how bad 8% mortgage rates are. And I feel like that could be something that bubbles up. I mean, we saw this a little bit, totally different, but when the FHFA rolled out something about the DTI, they were going to change the DTI things in the spring, and it went out it just went viral. And like your normal person who doesn't know anything about it, because of the LLPA changes, because of those two things were together, it felt like there was like this storm from a level of like, your kid's going to say something about it, your neighbor, your aunt, whatever. And I just feel, and it got changed. And I feel like this 8% could be that for the Federal Reserve. What do you think?
The NAR, Lawrence Wan, just came out and literally said, hey, this is not good. 8% rates are not good. And, everybody kept on saying home sales have bottomed. The forward-looking tracker data, we did have 3 good months. That was November, January, February. And after that, we're just going back and forth. But higher rates for longer, we're not crashing, but you're not having more positive prints anymore, right? So we're actually negative for the year. 8% mortgage rates don't help with that. So it's one of these things. I don't know what the Federal Reserve wants to do with housing, but because they made it the housing reset, and this is why Jay Powell made a mistake by saying this, you're going to have to own it, right? And then when Neil Kashkari goes, oh my God, home sales didn't crash, or the brakes never get, listen, Sarah, they need to be sit down and like have like somebody teach them like how to read housing data, how to read economic data in relationship to housing, and why people won't list their homes. We talked about that a few months ago when Barkin from the Fed says, I don't understand why higher rates would prevent people from listing their homes. I'm like, oh God, why are you people like this? So yeah, 8% gets your attention because I don't remember 8% mortgage rates. I was in high school, I think, at that point. And, the rates got as high as what we saw in December of 2000. And people would naturally think home prices should be crashing, inventory should be rising. And it's not happening because Sarah Wheeler, credit channels run inventory channels. And when you have the positive aspect, as I try to portray in CNBC, homeowners are doing well. Nobody sells to be homeless. It was a really bad theory, whoever made that up. But being stuck was always the fear housing in this period, and we're being stuck. And something's going to have to unbreak this. And I always said that the one thing that got transaction going was lower rates, and that's all we can do at this point. But then that's the bond market, the economy, inflation, these things, and we're just not there yet to get rates low enough or for a longer period of time.
We may have just gotten back from Gathering of Eagles, but we're not done with events for 2023 yet. This October, we're headed right back to Austin, Texas for HousingWire Annual, and we want to see you there. We've got a power-packed agenda with content such as our Women of Influence speakers, peak performer playbooks, CEO playbooks, and more to propel your company forward, as well as a bunch of networking events. Because this event is open to real estate executives, mortgage, title, and everyone in between, you really have the opportunity to network with people from all across the housing ecosystem. If you want to learn more about the event, or if you're already ready to get registered, head over to HousingWire.com on the events tab and you can learn all about it. Not to mention, if you're an HW Plus member, you're going to get 50% off your ticket. So get registered for HW Plus and get registered for the event so we can see you out in Austin.
What you see all over the internet is, all those people talking about like, yeah, grandpa, you had higher rates than this, but your house costs like, $50,000. I don't want to hear about it. And I think that is the difference here, is that it's not just higher rates, it's higher rates with really high home prices. To your point that you were talking about at the top of this podcast, like this is the 1970s inflation that the Fed should be worried about, right? Is like this unaffordability.
The 1970s had a massive housing boom, right? Higher rates, higher home prices, rent inflation took up. That was a much different dynamic. We had, the baby boomers coming into the workforce. The women were coming into the labor workforce. We did not have, of course, the products and home prices went up, but mortgage rates getting up to 10, 12, 13%. We had a crash in sales at that point. We went from 2 million to 4 million to 2 million home sales. Now we went from 4 million at the lows of COVID to 6.7 million at the highs, and then back down to 4 million. So in some ways it's similar in that sense, but we don't have the 1970s inflation in terms of rent inflation. Oil, even in itself, adjusting to inflation is not as big as it was back then. I mean, we had some really hardcore issues in the mid to late 70s, which are different now. So there's nothing you can do. The bond market, the 10-year yield and housing have this really relationship, the slow dance that we always talk about, Sarah, between mortgage rates. And as of right now, we're just basically just 2 basis points underneath the peak level of what I thought the 10-year yield would be. So mortgage rates are still above 7. Again, I think there's going to be a total dynamic shift going into when we get into 2024, which will cross that bridge at the end of the year. But we're at a different stage right now than we were, I would say, last year at this point. Last year at this point, things were crazy. The dollar was super strong. The 10-year yield was skyrocketing. London was going to lose its pension funds. The Bank of Japan intervened. The IMF was getting Ethan Hutt to tell the Fed to stop hiking rates. And we don't have that kind of marketplace. So there's a little bit more stability. And of course, now, back then everyone was thinking we're going in recession. Now, people are more talking about a soft landing. So it's different, but we still have the same core issues. Too many people still chasing too few homes. The too few homes is the real problem, as inventory channels broke to all-time lows past 2020 and is just savagely unhealthy.
It is savagely unhealthy. Yes. As you know, I had Mike Simonson on the podcast this week. I guess this is going to actually be published next week, but had him on recently. And we were talking about the inventory and just the dire situation that we are in many markets right now. So you're going to get the inventory, the Altos research data soon. What do you think?
Before I address that, what did Mike Simonson tell you about the mortgage rate lockdown?
We're not going to talk about that, Logan.
What did he say?
Okay, he said he agreed with you, but he came at it from a different, he's coming at it from a different data point, but he sort of agrees with you. Yeah. Okay.
Okay,
But what
so
did I say to
both of your data miners have a concept. We might go at it in different ways, but you might want to just follow your experts on this one.
Yeah, no, I really do trust my experts, but we are going to have a good conversation about that at HousingWire Annual. Everybody should come because not only are you giving a keynote, and Mike is speaking as well, that you and I are going to have a showdown live podcast about the mortgage rate lockdown, and we would love to have our audience there participate. So that's going to be good. So that's a whole separate thing in some ways. Let's talk about inventory because, this is when you always do the tracker and what are you seeing? You purchase apps, all the
I'm
things.
just hoping that new listings data does not have a noticeable decline. I'm just crossing my fingers and just hope that the next few weeks we just have an orderly seasonal decline, and I don't have to even whisper the words. We have another new leg lower. At some point, this has to end. One of the things about a mortgage rate lockdown, the theory that nobody would move their homes. I mean, we would actually have new listings data. The last week was around 60,000. It would be about 15 to 20,000 if there was a conceptual mortgage rate lockdown. I mean, you would just shut down everything. We still have buyers and sellers. People are still moving. So there's enough activity to still get about 5 million total home sales, or roughly around there, depending on where rates go for the rest of the year. But I'm just hoping active listings grow. New listings data, it's declining, but it slows down and just has an orderly decline toward the end of the year. And we start 2024 in a better spot. And one of the things I try to, or I emphasize on CNBC is that, you give the numbers for the previous week is 492,000 single family homes. Okay. 492,000 single family homes for a country of 335 million and 156 million working, 156 million people working. Okay. Then you go back to 2015, which wasn't that much historically anyway, but we were 1.2 million. So choices are a good thing. That's my belief. More supply is the best way to defeat inflation. More supply and more choices is a positive. When you break down what we saw in 2020, was we were in a bad spot, and we let the pack of hyenas run around TikTok and YouTube and tell us, oh, we're going to have a massive inventory. Here comes the forbearance, and here's this, and this is a historical period of time. What have homeowners showed us? They're a lot tougher than stock traders, YouTubers, TikTokers, and people on Twitter, and they're doing well financially. So they need a reason to sell their house. If they can afford another house, they put them on the market. Sellers or buyers, right? We don't have a job loss recession yet. That is a different variable when we cross that bridge. And I just want something orderly because I don't want what happened the last few years happen again in 2024. The spring inventory seasonal bottom is March and April, and we're doing this again. And, at some point rates do fall, and all of these people are sitting here waiting for rates to fall. And then you go, okay, here we go. Now I feel more comfortable buying. And then again, you're back in that situation because we're not anywhere normal. And that's always the fear. I mean, it's been a consistent talking point of mine for a reason, because I'm not worried about this mass inventory, people selling to be homeless, stuff like that. We have tested this really 4 different times, and it's tested with flying colors because fixed debt costs, rising wages, credit channels are normal. They're boring because the 30-year fixed mortgage is boring. So this is where we are. We are in August of 2023, right? And this is the market we're dealing with. That's why we created the tracker. So all of you have the raw data that you could talk to your clients, you could explain to your friends, that crazy uncle you have that thinks everything's going to blow up every single day. No, your job is to give them the information.
So let's talk a little bit about 2024, right? So what we don't want to do, fingers crossed, as you said, that unlike this year, when January, we had the highest, inventory in January. That is not good. That does not bode well. We need to get some more inventory coming online before that. Or if, whatever we are in January, we want to see inventory come online February, March, April, like a normal year, right?
What we want to see, what I was hoping to see this year, is that the seasonal bottom happens in January, and then January, February, March, April, May, we have the normal increases in active listings. The exact opposite happened. And partly some of that is demand got better, right? As mortgage rates were falling, the forward-looking data, the November, December, January forward-looking data was positive. It gave us one of the biggest month-to-month sales prints ever recorded in history. And that pushed out the seasonal bottom in April. And then we had the zombie, right? When I was on CNBC in May, I said, it really looks like a zombie. And they were like, but we have year over year percentages in inventory. Yeah, that's, if we're continuing this way, we're going to be negative year over year, which was a hard concept for people to understand. They're like, how could inventory be negative year over year with sales low? Yes, it is. Inventory channels are different. So that's what I'm hoping for. Again, we cross that bridge in January, especially the first few weeks. That'll be really key. But it's definitely not boring, Sarah. The previous expansion was so boring. Oh my God. It was such a boring housing market. It was painstaking, but we only had a few episodes where it got very interesting. Here, man, every second, every day, things are wild and different. And I think it's, again, for someone like me that does nothing else and look at charts, we inhale the information. It's religion to us. It's feeding, it's oxygen. But for everyone else, they're normal people and they have normal things to do. So it's our job is to try to tell you the story by giving you the math, facts, and data, and for it to make sense. And it's complicated. It's complicated. For those that saw the CNBC interview, you could see that, there were some, but what about this? And and I said, yeah, it's just one of these things that you have to break down the housing data piece by piece and try to explain it to get everyone to have sense with it.
So the last piece of housing data I wanted to ask you about was the builder's confidence. So we did see that change this week, this month, I guess, and that's a big deal. I mean, you've been tracking, why are the builders so happy, or the builders have this advantage? So what happened?
So I always, the builder survey is very efficient, and when it started to get better, and starting from November, the forward-looking data, people didn't go with it, and that traditionally is what happens. And right now, what I'm keeping an eye on, as rates go up higher, the forward-looking data for them, what they think 6 months, fell back-to-back months. So that to me means they feel less confident from where they are. Now they're elevated from the recent lows, but this could mean that we're just going to be in a very choppy month to month, positive, negative, positive, negative. That actually was very normal in the previous expansion. But we finally hit the limit after that really strong, almost like a halfway V-shaped recovery in the builder's confidence. Of course, the builder stocks were doing really good. The sales are up over 20% year over year. Different marketplace because of the buy downs. But again, as rates go higher, it costs them more, and the rate variable goes up higher and higher. So we finally saw cracks in that system. And again, we track that survey religiously because it's been very effective for the last few decades. It takes the human element out of the equation where people just think, oh, it's going to go back down. If it turns, it turns. You go with it until you see a few months of that not going. So we've had back-to-back months. That's what I'm keeping an eye on for them.
Got to keep an eye on that because, of course, that would be great to have some more inventory come online, but it is also spread out and in different places. Then it's not just like everybody can go and buy a new home. They're more expensive. And also, I mean, I know, at least I can speak to Dallas, like it's not even the first ring suburbs. It's like the second ring suburbs is where all the building is.
They're clustered, and I always say that the existing home sales, when you have normal inventory, has always a geographical advantage over the builders because they're spread out everywhere. Where the builders just find a unique area where they think it'd be the best demand for them. So in this context, for now, they're the only game in town. I know Warren Buffett recently put $800 million into the builders. It's not that big of a position for him, but again, as long as existing inventory is low and the builders have the ability to buy down rates, advantage, disadvantage, they never had an advantage in the previous cycle. Now they do in this environment.
We will keep watching, Logan. Thank you so much for being on with us. We're so happy to have your analysis. We know why CNBC loves to grab you and get you on and give you on the top spot on Squawk Box, but I'm really happy that we get to talk to you several times a week.
Pleasure's all mine, Sarah, even though you always try to tell me to stop leaning back and forth. Stop it. Hook yourself to the something. And I was just like, Unleashed Logan is the best slogan. And wait till HousingWire Annual. I am going to put on a show because I can't get in too much trouble from you guys who are in other places I have to behave. And it'll be a lot of fun for the people there.
It will be. For those who, they don't see the raw footage of this podcast, I have to tell you, I'm like, lockdown, Logan. We need a mortgage rate lockdown for Logan where he's locked down, but he resists it every time. Well, thank you for being on. We'll talk to you again soon.